Hi, this is Jay Woods of Freedom Capital Markets, live at the New York Stock Exchange, where now we're ringing the closing bell. I'm happy to be a great guest on the final bar coming at you right after we close down the markets. So Dave Keller, thanks for having me on.
Thanks so much, Jay. Hey, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close here today as we kick off month number 2, February 1st. Talk about the market environment. Yesterday, we talked all about the sell-off related to the Fed day. The drop that happened during Powell's press conference really put a damper on the optimism we've seen for quite some time here for stocks. Today, we're right back to life. The S&P, the NASDAQ, both up over 1.2%. Nice rebound day after yesterday's sell-off. Today, we got some not so insignificant earnings. Some small companies you may have heard of called Apple and Amazon and Meta dropping earnings here after the close. So certainly a lot of potential catalysts to still digest as we continue the week and close things off on Friday. But with that in mind, let's look at the markets here in our market recap and see how things have played out. Do want to share with you a poll question we asked you recently. Is the next 10% move in the S&P 500 up or down? Simple question. 38% of you said 10% higher. 62% of you said 10% lower. And I find this an absolutely fascinating answer, right? If you think about the S&P right now, around 4,900. We closed today around 4,906 today. So about 500 points would put us at 5,400, which it seems like a long way away. It's only 10% up from current levels. A 10% drop from here will get us down to around 4,400. So the question is, what happens first? We go up to 5,400 or we retest the 200-day, which is down here around 4,400. Almost 2 out of 3 of you said down first rather than up. This is a tough one, and I would tell you I intentionally asked this in the 10% range because 10% is a pretty big move. Now, in a rallying market or in a big rising market or a big sell-off, 10% can be eaten up very quickly, but in a slow and steady gaining market, which is more what we've been in, sort of that low volatility rise, 10% can actually take quite some time to chip up away and get all the way up to those levels. I'd probably say 10% lower, but I don't feel great about either one of those. I'd be interested to see if we do get to 10% higher. That'd be around 5,400 at the end of 2024. That sounds pretty rich to me, but days like today with nice rebounds after a sell-off certainly suggest that buyers are on the sidelines ready and willing to jump back in on any sort of price dips. It's probably one of the most bullish things I can tell you about today's price action. Let's continue on with the market recap and look at how the major averages finished off here. The S&P 500 up to close over 4,900 once again. That's up about 1.25% from Wednesday's close. The NASDAQ Composite ending the day around 15,362, we'll call it. That's up 1.3% from yesterday. Mid caps, small caps, all up about the same as the S&P. No real differentiation today from the largest to the smallest, which actually is a little unusual. We've often seen large over small, small over large, some big dispersion between the two. None of that today. It was sort of a nice up day across the board. And again, this is after yesterday's pretty big drop going into the close. Volatility remaining quite low. So as the S&P bouncing higher, the VIX down by about 0.5 point. So back below 14. And again, even with the bounce higher we saw in the VIX through the course of this week, still pretty low, right? The VIX remains below 14, below 15 for this stretch. And a VIX below 20 is still a low volatility environment. That tells you when you have those sell-offs like we saw yesterday, until the VIX gets above like 20, if not further, these are just short-term pullbacks within a long-term uptrend. You look for a much different set of indicators or a much different set of levels from the VIX, from some of the breadth indicators that would tell us we're in more of a sustained decline. This is more a pullback within an uptrend for now, and today's bounce sort of validates that general way of thinking. Now, bonds rallied pretty good today, too. So both stocks and bonds were higher. The TLT is up about 2% today, and interest rates, of course, then going down. So the 10-year yield finished today around 3.87. The long bond yield around 4.1%. The 5-year yield right almost exactly at 3.8%. So rates are coming down, which is an interesting change from when we were talking about the 10-year yield last year going up to 5% and speculating at further upside for rates, what we would need to see. We've given back all of that and more. We'll talk about the chart of the TLT or the AG if we have time to do so. Obviously, just a nice rotation higher. Bond prices really pushing to the upside. On the commodity space, we have gold and silver both up 1.5%. All the other commodities in the red. Oil prices, natural gas prices, all down pretty big. So crude oil prices down about 2.6%. Energy sector was your worst performing sector out of the 11 S&P sectors. Finally, looking at cryptocurrencies, all green, not by much though, by crypto standards. So Bitcoin closing above 43,000 yet again. We're up about 1.4%. Ether prices right around 2,300, and that's up 1%. You can see the rest of the top 10 coins that we track all in the green. Interesting to note, at the top of the sector list, the top two performing sectors were the consumer sectors. Consumer staples number one, up 2%. Consumer discretionary number two, up 1.9%. Look at the next two, utilities and real estate, both up about 1.8, 1.9%. So in a nice up day, a nice rebound day, the biggest gainers were actually quite defensive. Besides consumer discretionary, certainly more traditional offense. The other three are really the three most defensive sectors that you can find. So this is an interesting environment. This is not sort of the up day and it's all growth at the top type of day, which has been very common, certainly off of the October lows. Today was a little different. This is more defensive stocks leading. And some of the value-oriented sectors actually at the bottom of the list. Here at the bottom, you can see energy finished slightly negative, but just barely, essentially unchanged from yesterday's close, but lagging very much behind our major benchmarks, which were up a lot more. The financial sector, communication services, 2 and 3 from the bottom. So two of the worst performing sectors today, technology and communication services. So interesting, kind of defense over offense in a lot of ways, and value, really more traditional value at the bottom, sort of the value cyclical leadership sectors like financials and energy. Let's go to a daily chart of the S&P, just kind of check in on where things finished off. So here's your 2-day pattern. I don't know if I would give this a good label. I guess you'd call this a bullish inside day, I guess, bar chart wise, but it's not something I usually talk a ton about. Bar chart analysis, you're kind of looking at closes and highs and lows and just looking at the relationship. And outside days where you have 1 day's range and then a wider high-low range on day 2. This is more of an inside day where you have a more narrow range, but they're both pretty big. But the reality is yesterday was a drop. Today we basically erased all of yesterday's drop. So all of that stuff we were talking about yesterday about the Fed being more dovish, pushing the starting line for rate cuts down the calendar a little bit or further out into 2024. Risk assets coming off going into the close as a result of that. Today we erased all of that negativity and got back to yesterday's open. So just in 1 day, think about how these I guess the character of this market can certainly evolve. Now, having said that, we've pulled back off of previous highs, which means you really want to see a regaining of the previous swing high to validate that a pullback is over. But a day like today, kind of a nice rebound day. Of course, after the close, we have 3 key stocks among many others reporting earnings. We'll get to those charts here briefly as soon as we can. I do want to start looking at the the AGG. This is a bond ETF that we like to track. So 2 bond ETFs we tend to look at. The TLT, which is basically Treasury bond ETF, and AG, which is sort of bond, corporate and Treasury bonds all mixed together. LQD is the corporate bond ETF that we tend to look at, those 3. Now, just from a purely technical perspective, forget what you know about the Fed and about rate environments and all of that kind of stuff, and just look at the chart. What is the chart telling you? My initial glance, tells me from a larger term time frame, it certainly looks like a double bottoming kind of pattern with the October low in 22 and the October low in 23, very similar levels, and we've obviously bounced off of those levels here previously, which is pretty encouraging. You also will note this range here, which is sort of in that 97 to 98 range. That was the high in February of last year, also the high in April and May of last year. We gapped above that point and broke above there here in December. We pulled back then right to that breakout level, remained above an ascending 50-day moving average, and now we're actually rotating higher to make a new 52-week high today. So to say again, bond prices just made a new 52-week high today. So what does that mean? I mean, if this was a stock, I'd consider this a pretty constructive pattern, right? Higher trend going into the end of last year, a bull flag pattern. And a bull flag pattern, if you're not familiar, hopefully you are because we mentioned them on the show, is where you have a big run higher, and then you kind of have this parallel decline. The way you do a parallel line is you put the first line, you hit the Command key or the Alt key on your keyboard, you drag it down, you get a perfect parallel line there. So here's the highs over the last 6 weeks to 8 weeks. There's the lows. You can see pretty much lining up beautifully. What you wait for in a bull flag pattern, this is usually a brief counter trend move before the uptrend resumes. And the way that you confirm that that uptrend is resuming is you break out of the pattern to the upside. That happened yesterday, and we followed through today. So thinking of that as a bull flag pattern, that basically means bond prices in a nice uptrend. The momentum is strong because the most recent pullback remained above the 40 level here. We pulled back to an ascending 50-day moving average. We've now resumed the uptrend. Pretty constructive chart, and holding above the previous highs is pretty meaningful. So everything I just said basically is an argument for how and why rates should go much lower than they are already. The 10-year yield has already come from 5% down to 3.8%. Now, if you look, this bear flag pattern on the chart of the 10-year yield is sort of the opposite of what you saw on the TLT. So here's the drop, and then you see this rally here in rates. I'll kind of make that a little bit better. We make a, whoops, we don't draw a new line. We then make a parallel line like this. So there's our top, there's the bottom of the flag. We've now broken down through the flag, and the pattern continues lower. So this basically suggests rates have a lot further downside to be had. And I'm immediately looking to the left in the chart. Does the 10-year yield get down back to around 3.25? That's where we were in the spring of 2023. That seems like such a long way away from 5%, but we're getting there. It's getting closer and closer here in the below current level. So bonds going higher, interest rates going lower, and that could be a key new theme really for the beginning of 2024. A couple other charts here as we continue on our market recap. I do want to talk to you about offense versus defense. This is a classic chart that I followed for years, looking at the XLY and the XLP, consumer discretionary, things you want, versus consumer staples, things you need. The argument for this sort of chart is when things are bullish and when you've got money to spend, then you spend money on discretionary purchases like travel and hotels and new watches and cool cars and all that sort of fun stuff, right? Fun entertainment, you don't need it, but it's kind of fun if you can swing it. Staples are things you're going to spend money on no matter the conditions, right? Even if you don't have a lot of capital flowing around, you're probably still going to buy cleaning products and personal products and food and beverages and those sorts of things. Tobacco, of course, fits into that category as well. So when this ratio is going up, that means the discretionary purchases, the optional purchases, those companies are thriving, meaning people have money to spend, or the expectation is that they will. When this ratio is going down, which is what it's done for the last 6 weeks, that tells you the opposite. It tells you the discretionary stocks are not doing as well. Now, this top half is a cap-weighted ratio of the XLY to the XLP, and that numerator, the XLY, is dominated by 3 stocks. Amazon reporting earnings today, Home Depot still holding up pretty well, and Tesla, which has gotten absolutely killed here recently. So the Tesla effect is very much being felt on the cap-weighted version. So look below, which is the equal-weighted version of that ratio, and you can see that it's actually been more consolidating. So as the S&P is testing a new high, closing back above 4,900, it's worth noting this ratio is very much not doing so. So instead of offense over defense dominating and being a recognition of the sort of offensive plays leading, this is more of a measured way of assessing leadership and telling you consumer staple stocks actually starting to come into their own. By the way, today's guest, Jay Woods, brought a consumer staples name with him that he thinks you might want to pay attention to. So make sure you check out the interview we have coming up very shortly with Jay Woods from the New York Stock Exchange. I do want to mention the McClellan Oscillator chopping around that 0 level. We have this color-coded chart where we show in the McClellan oscillators above 0. That's a bullish breadth condition. Below 0 is in red. That's a bearish breadth condition. We went negative about a week ago as we popped above the 0 line. Yesterday's sell-off pushed it fast below the 0 line. I have not seen today's reading yet because we're still crunching the data here at StockCharts, but I would be pretty surprised if it wasn't back above that 0 line. So it's sort of in a neutral, right at the middle. I don't have a neutral setting on the McClellan oscillator, but it is actively going back above and below that 0 line. It's really talking about speaking to a market in transition. Final one I want to show you here talking about breadth is the bullish percent index. And what's so interesting is we talk about breadth conditions being very strong. Overall, I can't disagree. I mean, there's some general strength that we've seen here. Most stocks still above their 200-day moving average, of course. Yesterday, Tony Dwyer talked to us about his way of measuring breadth, looking at breadth participation, stocks above moving averages. He saw that as a long-term, very bullish signal and had the data to prove it. The 6 to 12-month returns looking forward after those signals have actually been quite strong. But I'm seeing in the short term signs of concern. This is the bullish percent index on the S&P 500. It was just above 80% at the end of last year. It's now down to about 65%, and it's been steadily declining. So what's interesting is Some stocks are breaking down. So about 15% of the S&P have broken down and given a sell signal from their point and figure chart. And that usually doesn't mean it's just turning over. That means it's actually broken down and triggering a new swing low using the point and figure methodology. I'd keep an eye on that chart. As long as that keeps going down, that really doesn't speak to broad strength, at least in the short term for stocks. Now, we have a lot of individual names. You know, sometimes on this show, we spend more time rather than others on individual stocks, but with earnings happening right now, a lot of companies on the move and sort of these binary outcomes. Stocks can gap higher or lower very quickly based on their earnings release. So we're going to go rapid fire through maybe 10 names or so, see how many we can get through with the remainder of our time. Honeywell is an industrial stock. We'll talk about a couple different industrial stocks. And I do want to highlight, this is basically a hammer candle. Yesterday, we had traded lower, giving what's called a dark cloud cover, which is we have a big run higher. We have a higher open, but we close at least half the way through the previous candle. This candle focus chart might be a better way to show that. Yeah, here's that, what's called the dark cloud cover, a run higher, a higher open. We close at least 50% of the way down through there. If you're studying for your CMT exams, remember that one, dark cloud cover, bearish, and you can see we gapped lower today. Now, what happened today, a hammer candle right at the 200-day moving average, and I love this chart because it combines candle patterns, which are actually a very short-term technique, looking at intraday sentiment, which is bullish here, but it also looks at the 200-day moving average, which is more of a long-term measure of trend strength. So the fact that we opened here, we traded below at around 196. We traded all the way down to 190, even below that, below the 200-day. But by the close, buyers literally came in and pushed the price back above the 200-day. That's what tells you it's a short-term bullish sign. So Honeywell gapping lower, but actually nice accumulation through the course of the day today. Next one to look at is Peloton. I won't show too many stocks making new lows, but I was taught nothing good happens nothing good happens below the 200-day moving average. That's a Paul Tudor Jones kind of quote. And if you look, Peloton gapping lower today, really retesting the October and November lows from last year. But you know, my comment is this is a stock that has failed to get above its 200-day moving average so many times in the last 12 months. So I'm excited when stocks get above their 200-day and show signs of accumulation. We're not seeing that. Peloton's gapping lower, but that's just the latest downtick within a longer-term downward structure, which is why I've tended to avoid names like this below a downward sloping 200-day moving average. Royal Caribbean's an interesting one because we're actually stalling out at previous highs. So, you know, I think with a lot of stocks like Home Depot and others, they had a high at the end of last year. They pulled back a little bit, now retesting those highs. This is actually giving a bit of a distribution pattern, a bearish outside day today, which means we trade higher, but we close lower, and the range of today has expanded. So higher volatility, lower price action is sort of a negative short-term signal as we retested the previous high. So Royal Caribbean, for now, stalling out at its previous high around 130. I think this is a bullish chart above 130, but the key is we have to get above there, and I think being patient and waiting for that breakout is pretty important. As a good example as to why we wait, Zions, which is one of the regional banks. Well, again, Jay Woods will talk about banks here in a moment, but you know, Zion is stalled out at $45. We reached there in December on a gap higher. Ended up being sort of an exhaustion gap, the end of a move, one final gasp higher, and that ends up being the high water mark. We retested $45 in the last week. Now we've traded lower. We're back below the 50-day moving average. We have failed to eclipse those previous highs. That's why a lot of times I talk about waiting for that breakout and being patient, waiting for that trigger, a break to a new swing high. Zions didn't pull that off, and now we're breaking down and testing, sort of the recent swing lows. Now, it's not all bad. There are some stocks doing just fine. Stocks like Merck making a new 52-week high today. As a matter of fact, there are plenty of stocks making new 52-week highs. I'll show you a couple of them. Merck right now has been overbought really for the entire year. We're about 5 weeks into the new year, and it's been overbought that whole time. Overbought means up a lot. Stocks like Merck in the healthcare sectors are moving to the upside. Within the industrial sector, Eaton Corp gapping higher on earnings, trading up about 7.5%, making a new 52-week high today. Within that same sector, industrials, you have Parker Hannifin, which is an industrial machinery name, gapping up over 7.5% today. Trane Technologies, that is TT, gapping higher about 7.5% as well. Again, what's interesting about Trane Tech is like, could you predict that there would be a gap higher of about 7.4%? I don't know if I'd feel comfortable predicting that sort of gap. Gaps are actually very difficult to pinpoint ahead of time, if not impossible. What you can do is recognize the trends leading into that gap. And the trend in TT and in Eaton and in Parker Hannifin have been remarkably strong. This is what draws me to a sector like industrials. When we talk about a leadership rotation from growth to value, some of these industrial stocks are the ones that really speak to me. Now, as a reminder here after the close, we've got a couple key earnings to pay attention to just to finish off our market recap. Apple, which has been languishing below that kind of $195 to $200 range, reporting today. We have Amazon, really in a primary uptrend. I'd like to see if the 50-day could hold in any sort of negative disappointment, any sort of pullback. And the same can be said for Meta. Now, the 50-day moving average is about 40 points below current levels. So you've got about a 10% range from where we're at the close to where we could gap lower. So higher highs and higher lows are an uptrend. As long as these things pull back and make higher lows, that primary uptrend still in play. That's it for our market recap. We're going to bring on today's guest, Jay Woods, here in a moment. Before we do so, just a quick reminder, we love hearing from you guys. We've had such great questions recently, and we'd love to get one from you. You can email us your questions at thefinalbar@stockcharts.com. We're on X at FinalBarSCTV, and on our YouTube channel, of course. Just drop the comment below the video that you're watching. Again, we love hearing your feedback on our show, on our guests, on how we're formatting things and what we could focus on. But as always, your questions are most appreciated. Very excited to bring on today's guest, Jay Woods. Jay's the Chief Global Strategist at Freedom Capital Markets. Today, coming to us from the floor of the New York Stock Exchange. Jay, good to see you again. Happy New Year. What's the feeling on the floor with a nice rebound day after yesterday's drop after the Fed?
Yeah, that one-day panic sell-off, it seems to have subsided, and we'll wait for some earnings that are going to come fast and furious after the close to really see what sets the tone. But I think we digested that Fed news. Fun fact for you, I didn't know this. This is thanks to Bespoke on Twitter. During Jerome Powell's Fed residency or presidency, it's kind of both. The Fed, on Fed days, we've been down an average of 1.5%, regardless if we hike, we cut, whatever he does. And yesterday we were down 1.6%. So it's kind of par for the course. But when you make new highs and you get that first sell-off, people start to question it. And I think we answered some of those questions today, and the earnings season will take us through and see if we can stay above 4,900. Start getting those 5,000 hats ready. And if this market broadens out, because that's what we're waiting to see, if the broadening out can continue.
One of the best measures of sort of broadening participation is looking at small caps. Obviously, there's been a lot of discussion of the markets being led by those mega cap names, a lot of them reporting earnings. Talk to us about the small cap space, what you see with IWM really threatening the upper end of the range here.
Yeah, when we talk small caps, we talk Russell 2000s, we talk the IWM ETF, which I'm here to share with you. I heard a lot of chatter, especially on social media, about what we call bull traps, bear traps, false moves where you can get false moves where you get fast moves in the opposite direction. These are the hardest things to predict, and I am not calling for this to be a bull trap because something changed here. We had a nice, long, neutral trading range. We've highlighted the resistance area, but if you were to put a line underneath that, the support area, three major times over a year period, we tested the lows, we've held. We did break out of that range. But how did we break out of that range, Dave? Let's go back in time. November, December, the Russell was up 27% in a straight line from the low to the high to the breakout. It's going to retrace. It retraced 8%. That's about a third of the move. That's a healthy retracement. But as it retraced, it broke through what we hoped old resistance would become support. So that level did not become the floor. What is acting as the floor, what I am watching like a hawk, which we tested not once, but today twice and rallied off of, is the 50-day moving average. I've highlighted it 1, 2, 3, 4. This would be the 5th time that we've been in this neutral trend where we've tested the 50-day moving average. The first 4 times, it broke through the next day, if not the same day it was testing it. This time, we tested it, we rallied back to the 2,000 mark in the Russell, so about 200 in the IWM, and we failed. How did we fail? We failed 2 reasons. Fed day, and then some weakness we saw in the regional banks. But what happened today? Intraday, we tested it again, we held. We closed near the highs. This, to me, is positive price action. The Russell was able to shake off the second biggest, now it used to be the biggest sector until the beginning of this year, The second biggest sector in the Russell, financials. Now the industrials have it by like 0.01%. But the financials, the regional banks, if they can hold here, and they're being tested, we'll talk about them in a second, I think we're going to be okay. And seeing the price action and seeing the Russell hold this level, I'm watching 200 in the IWM. I want to recapture this level. And then I think the broadening will take place. This pullback to me has been normal. It's a little scary. Then I look at MACD crossovers. I highlighted a few of them. The most recent one was at the low. Other lows, we had MACD positive crossovers. I jumped the gun when I put this chart out to you 2 days ago, but we were about to have another MACD crossover. It has temporarily failed. Watch to see if that can cross over positively as well. It's doing it at a higher level, which I like. That's a nice bullish divergence. So I think the Russell is set up, holding these levels, risk reward. If it doesn't hold, get the heck out, try again. But if it holds, I think we finally take that leg higher and we broaden out as this market continues to, take this secular bull leg higher and bring a lot of people along for the ride outside of these mega caps we like to talk about all the time.
Yeah, you mentioned our growth-oriented benchmarks, very attuned to specific sectors, technology, communication services. Small caps, you have a much different sort of representation. Industrials, financials, now the two largest sectors. Talk to us about regional banks, a lot of small cap banks. It's a much bigger weight. The last couple days, a little bit choppy, but this is testing now a support level, right?
Yeah, well, I was supposed to show you the uptrend and how it flagged nicely, held this nice support level where we broke out above. Just like the IWM, it pulled back, it held. We got a little news that scared the regionals. At one point, the KRE, which has, I believe, 125 components in it, most of those components are in your Russell, all 125 were down this morning. That started to change. The breadth within the index started to pick up, and we closed well off the lows. So what I am looking for closely is over the next day, yes, one day, this can tell us whether or not this is a one-off event and New York Community Bank is not going to take the others down with it. The banks that did go to the downside were the same culprits that took us down in March, Western Alliance and Zion. These were two names that were very short heavy and led on the downside before. These were the laggards today, but the rest of the index, they caught a bid. Some of them finished positive. So watch the current levels. We want to see them hold. So I would be active as a buyer if we can see a little bit of a rally from these levels, say 50 cents, 75 cents from the 48 level. But 48 to me is a line in the sand, and I would be very careful trading this using stops. But if we can hold, recapture, maybe we have a nice little neutral trend here, but I think we avoided disaster, and this is good for the Russell. But tomorrow will be a very interesting day to watch, and so will next week in the KRE.
Now, relate what we said. Obviously, a nice bounce off of the lows intraday today. Take us a little bit further back. Thinking of the weekly chart, we're kind of pulling back from a longer-term trend line. How does that relate to the short-term sentiment here?
Yeah, the weekly, when in doubt, back it out. I don't know who came up with that. Dave, maybe it was you. I'll give you the credit for that. But,
I won't take credit, but it's an awesome thing to say, for sure.
Every scholar, technician, every CMT knows that. And, as you know, I love multiple time frames. It is still in a downtrend. It is testing it. This is the third time we've tested it. We failed again. We're holding barely this 48 level. So you got to continue to watch it. If we can dodge this bullet, we got through earnings season. New York Community was one of the last regionals to really report. Now, if we can dodge this bullet, which I think we will, but I'll let price dictate how I trade the stock, trade the sector. I think we will test that trend line again and hopefully break above it. That's what you want to watch on a longer term basis. If we do break it on the weekly, then I think, the leg, the push towards, obviously 52-week highs, but all-time highs, that's something we can discuss on my next visit back to the final bar.
We mentioned, to get to our next chart, we mentioned in our market recap how consumer staples actually starting to emerge a little bit. Consumer discretionary has been a much better sector on a relative basis, but staples starting to show some signs of life. You have a chart in front of us, Hershey. Talk to us about this potential bottoming pattern.
Yeah, we needed to sweeten things up here, and Hershey's has been a stock that's been down. It's been a nice steady downtrend for almost 9 months, and that something changed. It broke the downtrend. All right, it broke above its 50-day moving average. It stayed above the 50-day moving average. It tested it again. It held. Now what I see, it's a little push here. Those volume bars get in the way, but it looks like a possible head and shoulders bottom here. We have a defined left shoulder, a nice head, and then, that right shoulder is starting to form. We have clear resistance. If we can break above this 200 level, 198.50, let's say, I think we are in for some smooth sailing. And when these staples turn, they tend to turn quickly, and you very rarely get opportunities for momentum in staples. They're very boring. They're great long-term companies that you use every day, you put away. If Hershey's can break above this 198.5, 200 level, I think a run to its 200-day moving average, which is now above, I can't read my numbers here, but Dave, help me out. We're looking at a target of
about 218 up here.
218. We're talking close to 10% higher. That's a great return into staples, and I think Hershey's is poised from a risk-reward point of view. Let's frame it in that way, because I always look at things that way. It's in favor of the bulls, and you have an out where you can limit your loss and maximize your profit with this trade.
It's a great chart. The weekly chart testing the 200-week moving average and starting to, a buy signal from MACD recently. Overall, maybe setting up as more of a constructive condition here, right?
Exactly, and that's going back. Let's see where it is on a longer-term chart. Oh my gosh, we haven't tested the 200 weekly in a long time. It tested it, it held, it had some nice sideways basing action. This is what we like to see, the constructive bottoms, and now it broke above the 50-week moving average. I think this is, if you're looking for something to turn, this could be the opportunity for you. If not, on a longer term basis, it breaks the 200 weekly, get out again, you limit your loss, and you try to wait till the setup is more favorable. But right now, I haven't seen Hershey's look this favorable in months, and to me, it's a good opportunity.
When we have this sort of setup, we had Ralph Eckenpour, of course, who I know you know well, you're related. We had him in the office here earlier this week. I mean, just as always, a pleasure to talk with Ralph. And we talked about just rotation, right? I mean, his comment was it's less about a market rotating from bullish to bearish, more about a bit of a leadership rotation, sort of those mega cap names taking a bit of a breather, some of these other groups starting to improve. Would you agree with that assessment? This is more of a rotational move we're seeing here?
Well, yes, we're quoting the gentleman who said rotation is the lifeblood of a bull market, and it's something I use a lot. Yes, we want to see that rotation, and we've seen some rotation in the leadership. Let's just review back November, December. What led? It was the small caps. What kind of held back? Remember NVIDIA? It went nowhere from May to the end of December and then finally broke out. It had a great base. The leadership to begin this year was just like it began in 2023, and you had the mega caps minus Tesla, minus Apple. Apple's been okay, but it's not doing what we want to see Apple do, making a lower high. But we're seeing the mega caps lead, not as strongly as they did to begin last year, but we're starting to see the big financials. When we talk about the KRE, we're talking about the little financials, but XLF looks fantastic. This is what we want to see. This is the rotation we're seeing. You look at insurance stocks, oh my gosh, it's just a beautiful trend in the IAK. Now let's see how materials pan out. We have LIND, L-I-N is the symbol there. That makes up 20% of the XLB, the material index. They report next week. Let's see if that can finally break out of its neutral trend and help the materials, which made a higher low. So I think we're seeing setups to actually extend and broaden this rally. And if we can get through this one-day sell-off that the Fed caused and get through this earnings period, slow and steady is not a bad way to go. And that's what I think the theme will be. It could be boring. Election cycle, this is a period where you get a little bit of a lull, but we still have a long way to go to April. We're still in that strongest 6-month period, and I think the broadening will happen. It just doesn't happen with the alacrity and the headlines of those mega caps.
Jay, this has been a pleasure as always. Thanks for sharing some charts with us, some thoughts with us. Thanks for giving us a piece of the New York Stock Exchange here on the Final Bar.
Always.
And we'll look forward to seeing you again soon, all right?
I can't wait. Always great to join the Final Bar. Thank you, Dave.
That's Jay Woods. Jay's the Chief Global Strategist at Freedom Capital Markets, coming to us from the floor of the New York Stock Exchange. And what I love about talking to someone like Jay, who's, again, a successful trader with a fantastic career on the floor of the exchange, here's someone who has lived and breathed flickering ticks, the short-term movements, the short-term sentiment, but looking at daily and weekly charts and thinking about how today's action fits into the bigger picture. There is a brilliant nugget of investment wisdom there, recognizing the relationship of those time frames. And remember how someone like Jay is able to connect what we're seeing today, this minute, this hour, this moment, with the bigger picture trends, focusing on those key levels, those key lines in the sand that are most important to us. Great take, as always, from Jay Woods of Freedom Capital Markets. Folks, we've got to wrap the show and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. We're looking here at new 52-week highs and new 52-week lows on the New York Stock Exchange and the S&P 500. If you've not seen this chart before, we have the S&P 500 in the top panel. The next panel down is the net difference from new 52-week highs to new 52-week lows. And generally speaking, it's bullish when there are more new highs than new lows on average, and it's bearish when there are more new lows than new highs. And you can see when the market's trending higher, there tends to be more black bars here, which means more new highs than new lows. In downtrends, you have more red bars here, which means more new lows than new highs. Note how since the October market low, there have only been a handful of days where there have been more new lows than new highs. We're still seeing plenty of stocks making new 52-week highs. You can also see that below in the green bars here. So today, we had about 104 stocks on the New York Stock Exchange making a new 52-week high, about 43 names on the S&P 500. So that's, what, 8% of the S&P 500 making a new 52-week high today. Yesterday, yesterday on the drop, right? The Fed had their announcement. The market sold off in the last hour and a half of trading. We still had about 60 names. That's about 12, 13% of the S&P 500 making a new 52-week high yesterday. That's as the benchmarks were pulling back. So keep in mind, as you're looking for ideas, using the scanning engine on the StockCharts platform, there are names doing this. There are names breaking out, even though our benchmarks may be pulling back or maybe chopping around. Always be looking for stocks making new swing highs and see if there could be some opportunities there. Chart number 2 in our market recap, we talked about offense versus defense, and we featured this chart. Again, the top half is cap weighted, so it's really dominated by the larger consumer discretionary names, which is why I like to use the bottom panel, which uses 2 equal weighted ETFs representing consumer discretionary, things you want, and consumer staples, things you need. What's interesting to me here is the S&P 500 has been making a new high in December into January after the uptrend in the fourth quarter, but you can see that this ratio has actually been making a lower high. So we're not getting that confirmation of offense over defense. As a matter of fact, as our friend Jay Woods pointed out, stocks like Hershey's actually showing some signs of strength off of recent lows. So consumer staples may actually be an interesting place where assets could continue to rotate. Finally, I think Peloton is a cautionary tale for why you want to avoid stocks below their 50-day moving average. Now listen, if you want to buy a stock at $4 and sell it at $5.20 and book that gains, all power to you. Please enjoy, do it. That is not the way I like to approach things. As a more of a medium-term and a long-term investor, I like to look for strength. I'm looking for stocks that have shown to me that institutions are accumulating larger positions. Peloton is constructive to me above the 200-day moving average. And when you see a stock like this that has been languishing below the 200-day for so long, I think it behooves you to just be patient and just to wait. If and when, and probably more when than if, Peloton gets back above its 200-day moving average, that's when we can start talking about improving rotation. That's where we can talk about buyers really coming in, more of an accumulation phase, more signs that there is optimism, not just in 1 day or 1 week, but more sustained optimism. Those are the gains that only come when a stock is able to get back above its 200-day moving average. So I hope you weren't caught on the wrong side of this drop in Peloton, but it's a great reminder to me that prices usually are going down for a reason. It pays to be patient. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Jay Woods of Freedom Capital Markets joining us from the floor of the New York Stock Exchange. Don't forget to like our video. If you like what we're doing here, feel free to subscribe and join us tomorrow. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.